Thanks, Debbie. Appreciate it. Lovely to be here and meet everybody today. I've had some great conversations already over the course of the day, so I appreciate the opportunity to connect with many of you. I'm Gunjan Chauhan. As you've heard, I work for State Street Global Advisors. By the accent, you can probably tell I'm not based in Poland, I'm based in London. And I head up our global capital markets team for the SSGA ETF business, as well as our market intelligence team.
Hello, so Sławomir, Rzeszotko. I unfortunately, by the accent, you'd probably think I'm based in Warsaw. I'm based in London.
It was the same for me, Sławek. So.
But I work for Jane Street. It's a market-making trading firm. We do market-make ETFs globally, and my role is to run our institutional business in Europe and Asia.
Yeah, and oftentimes we talk about people's careers. So at some point, if you get to talk to Slav, he's had the opportunity to work at iShares and Vanguard and now at Jane Street. So he's kind of worn a few hats and has a lot of experience, and he knows a lot. I often call him. So we're going to talk about trading of ETFs in Europe. And so I guess a good starting point would be, maybe I'll start with you, Gunjan. When you think about trading ETFs in Europe, where and how do they trade?
Yeah, great question, Deb. So I think trading of ETFs in Europe is not necessarily a straightforward process when you compare trading of ETFs in other parts of the world, like the US. And there are a few reasons for that. You know, first of all, across Europe, it's a multi-listed, multi-venue, multi-country landscape where we have, in most instances, an ETF will be launched as a single product, but will then be listed on a multiple number of different exchanges in different countries across the European region. That in and of itself leads to a number of things. Perhaps some opportunity for clients locally to trade on their domestic exchanges if the ETF is listed on that exchange. But it also has consequences that cost the investor at times because it does fragment liquidity. And organizations like Slav, and I'm sure he'll touch upon it, then have to really price in perhaps some of the additional considerations on what that fragmentation of liquidity can do when you're looking to trade ETFs. So I would say that there are a number of different exchanges that ETFs can be traded on, but they're not just traded on exchange either. They are either traded OTC through bilateral conversations that an investor might have with their executing broker, or perhaps even through a multilateral trading system, like a Bloomberg or a Tradeweb, for example, is also another off-exchange venue where ETFs can be traded. And in the European marketplace, most of the trading is actually done off-exchange for ETFs than it is on exchange. I think the ratio, when we took a look at what SPDR ETFs are trading at the last look, was something like 75% is off-exchange, 25% is on-exchange across the European landscape. So it's quite an interesting landscape. You can trade in a variety of different ways with a number of different counterparties and over a number of different jurisdictions as well.
That's great. And maybe, Slav, moving to you, and we'll unpack a little bit of this. So when we're trading off-exchange, maybe you can explain to people who don't know what that really means, like what would be an example of off-exchange and why does it happen?
Right, so this is very interesting because it's something that's being talked a lot about as specific to the European landscape and something which causes potentially problems. I guess if we go back to what Gunjan said about like fragmentation of listings and fragmentations of products across different markets and different countries. We see more than 12,000 different listings of ETFs traded in Europe currently. And by the way, it's always extremely stressful to quote any statistics about ETFs when Debbie is in the room. So I'm very nervous right now. But anyway, this is about 4 times as many listings as there are in the US. And the asset base is obviously incomparable. There's much more assets invested in US ETFs than there is in European ETFs. So it means that we basically have much more choice as investors in Europe at the expense of fragmentation. And that fragmentation drives investor preference to try to figure out efficiencies in how they trade. And those efficiencies are in terms of like accessing liquidity in a way that might be aggregating this, complicated universe. So when you're trading on a particular stock exchange, you have access to ETFs listed on that stock exchange in the currency in which they are listed. As Gunjan mentioned, there are platforms which are completely electronified that operate on the request for quote protocol basis. And essentially, it's like an electronic auction, right? So you have, as an investor, if you have access to one of those platforms, you can send electronically a request for quote, as it's called, to one of several number of dealers. Typically, we looked at it last year, and in Europe, 7.1 dealers are asked on average on those platforms. And those dealers show the prices, and the best price wins. This is fairly straightforward and pretty efficient. It's so efficient that actually 50% of the requests for quotes traded in Europe end up executed in less than 10 seconds. So it's almost as automated as trading on a stock exchange. But obviously, it means that there's a whole different pool of liquidity that is like in existence outside of lit markets. And there are questions about both pre-trade and post-trade transparency, and maybe we're going to get to talk about that a little bit later.
Yeah, and maybe a good question to ask Gunjan, put her on the spot. How do issuers think about where they should list or cross-list? How do you kind of go through that analysis?
Yeah, it's a great question. Debbie, we did the analysis, and Slav has already told you how many listings there are. And when you compare the ratio of products we have across the UCITS landscape, it doesn't make sense. On average, most issuers will have around 5 to 6 listings for every single ETF that they have. How do we make that decision? It's a combination of things. First and foremost, we're going to be investor-led. Where are our investors wanting to have the choice or the preference? But when you do a double click on why they are requesting a particular listing in a particular country, it's not always to trade. In some countries, investors will require a product to be listed because they need it for perhaps valuation purposes. They need it to be visible and transparent, and they will not get that if it's not domestically listed. And that's perhaps as part of their own investment guidelines. So there are all types of specific nuances that I would boil down to require education rather than require a listing to be added. Because what I don't think investors want is to do anything that might negatively impact the execution quality of when they want to trade in an ETF or out of an ETF. And I think there can sometimes be unintended consequences of providing investors with what they think they want for a particular purpose that they're serving, which then might have a negative consequence that they might not perhaps appreciate in the initial request. So how do we make that decision? We're absolutely investor-led, but I also think as an issuer, especially as a capital markets team, we take a huge amount of responsibility in educating investors around what this means so that they can be eyes open in understanding some of those decisions.
That's a great answer. So Magda, you worked at the LSE, and they often allow you to list in different currencies. So how did people think about that, and what do you see as the benefits of listing the same product in different currencies?
Sure. So I think it goes down to the fragmentation of liquidity in Europe. Europe is a very, very fragmented market compared to the US. In the US, we don't have that many exchanges. The bulk of the trading happens with about 60% of all trades in ETF executed on exchange versus only the rest on RFQ and other off-exchange mechanisms. In Europe, we see exactly the reverse. So I think it's one of the key differences here. And with a unique ETF being cross-listed across many different jurisdictions, many trading lines, many currencies as well. So I think that fragmentation is there by default. But also in terms of the protocol as well. We in Europe we mainly use the off-exchange mechanism as the request for quote, with about 75% of the executions happening via that channel. So in terms of the countries being cross-listed, Brexit definitely didn't help. I think it's one of the key considerations. And you have the European markets that you can go into. In terms of the cross listings, it's from an issuer perspective, it's always a cost consideration, but you definitely need the distribution team there. So I think in terms of Poland, you need to think about the distribution to retail clients, to institutional clients as well, to have an attractive market to reach out and to be able to attract all of the flows. But it's always a cost consideration from an issuer perspective, bearing in mind that fragmentation that we're all trying to navigate.
And maybe, Slav, are there some best practices about times to trade or how to think about trading ETFs?
Absolutely. So I think the key thing to always remember is that ETFs are really products that are either tracking an index. I hesitated for a while because I remembered all the discussion about active and passive that happened just before. So either tracking an index or like at least tracking an investment basket that owns several securities. Therefore, it's like when you think about best practices of how to trade an ETF, I think it's always best to think about what exposure you are really getting into by trading this ETF, right? So if you're trading an ETF that invests in securities listed in a different time zone, that time zone, the closer you get to the time zone or the closer you get to a time zone in which like some liquid proxy instruments are being traded, is probably the best. But if you're trading an instrument, the ETF, and you can trade at a time when the underlying markets for that ETF are open, that usually means it's a pretty good time to trade. Also, just a lot of how you should think about trading ETFs is not so different from how you should think about trading equities. The product has the additional layer of liquidity coming from the underlying basket of securities that it invests in, but it's trading essentially as an equity. So if you do some things when you trade your equities, such as you're not sending market orders to the exchange, but you're usually working with limit orders, or maybe you are trying to avoid send your trades right on the open or during the time when like large economic numbers are being published. These are all fairly sensible things to do when you trade single stocks. And as it happens, they are also fairly sensible things to do when you're trading ETFs. So in many ways, I think for those who are not that experienced using ETFs, my advice would be, one, to really just like take a step back and think about what this ETF represents. But two, apply same common sense practices that they probably applying to all the other investments that they thought about.
And maybe coming to you, Gunjan, when we talk about liquidity having two types, most people wonder, like, do I have to call you and say, can you do a creation or redemption for me? So maybe you can just talk about how do people think about when they're doing a creation or redemption and what role you play in that process?
Yeah, absolutely. So look, I think I just add on to what Slav said. I think what the investor is looking to achieve as an outcome is also a critical decision point when you're deciding how to trade. Whether you're trying to, whether anonymity is most important, whether speed of execution is perhaps most important, or execution quality, and you have to sometimes stack rank the order in which you're trying to achieve those things as part of that decision-making process. And that's where teams like myself in capital markets, we play a role to help really support investors in understanding what is it that they're trying to achieve once they've made their mind up on what the investment exposure is that they want to achieve. How can then the ETF really serve the purpose that they are trying to ultimately meet as part of their overall objective? And through the primary market process, so obviously, as you know, Debbie, ETFs have a primary market where you will be able, through the open-ended ETF structure, to be able to either create or redeem ETF share units, but there is also a very thriving secondary market. And one of the key differences, amongst other things, is the primary market is accessed by what we call authorized participants. So Jane Street, Slav's organization, is an authorized participant. There are obviously others in the marketplace, but they will have the ability, because they contractually have that paperwork completed and the appropriate licenses, to be able to face an issuer, such as State Street Global Advisors, to be able to create ETF shares, and then they will act as an intermediary, or sometimes they will want to do this for their own trading purposes, to be able to create those ETF share units, pass them through to an end investor if they are working with one of their underlying clients, and the same for any redemptions. Those trades in the primary market also carry creation and redemption costs associated to them. There are primary market transaction fees that investors will also be involved in having to participate. It's worth keeping that in mind. In the secondary market, there's perhaps greater execution efficiencies for market makers, which Slav's organization play that role within, where there's more two-way trading taking place in that secondary market process, and there are not the primary market transaction costs for creation and redemption fees that are applied to that marketplace. So that's where teams like capital markets at ETF issuers really play an intermediation role, if you want to describe it in that way, between educating the investors once we understand what they're trying to achieve, facing off with authorized participants, and then we also play a vital role internally working with our portfolio managers where negotiations might need to happen, such as in fixed income ETFs, where we often will be involved in a negotiation of a basket, to be able to ultimately, between the three counterparties, serve the best purpose and outcome for our mutual end client. So it's not a straightforward process, but when you get there, it can be incredibly efficient to trade thousands and thousands of names with one execution.
That's great. And Magda, for retail clients trading just a couple thousand shares, how are they supposed to trade?
Sure. So I think the retail element is really, really important when it comes to growing the market. And I think Dorota Sierankowska, who is sitting here in the audience and will be up on stage next, has done an amazing job here in the local market, trying to educate people. I think it all comes down to education element, to make sure people know what the ETF is, how to use the vehicle, how it can trade. But in terms of retail participation, I think we can't ignore the digital channel, for sure. I think the digital platforms play an important part. All of the issuers can definitely leverage the digital marketing channel in terms of education, but also trying to push that growth that way. We've had representatives from Germany as well who talked a little bit about retail before, during the conference, and Germany is really the poster child for trading ETFs in terms of retail. It's a great market. I think the more education you can get, the more awareness among people. The female channel can be very important as well in terms of the chapter growth. So I think we can definitely push forward that retail participation a little bit more. But I think the democratization of investments is key when it comes to the ETF vehicle. It's really important. You can look at the retail and the institutional side as well. So you can't look at them in isolation. So I think facilitating both, but you need to use different language. Of course, a retail person is not going to understand what you say if you use too complicated of a model. So you need to have access to, first, the scale for the audience. Second, understanding the language, but of course, in line with compliance as well, to make sure all of the information is there in the KIDS and the PRIPS prospectus.
So, Slav, coming to you, there's a lot of discussion in the industry about consolidated tape. Maybe you can explain what it is and why we think it's something that should happen.
Absolutely. So that's actually a discussion that has been going on for very, very, very long time. Essentially, it goes back to how we started this panel discussion, talking about how many listings there are in existence and how trades happen both on and off exchange. So one thing that is pretty obviously helpful to understanding and navigating this this landscape would be to have a situation in which you can do some post-trade analysis and you can understand the total activity traded in any given ETF without actually referring to, Gunjan was pretty charitable saying that there are 5 or 6 listings per ETF, but if you actually want to capture the data, you're probably looking at like something like 20, 30, 40 symbols in some cases where you add all the MTF listings and when you add all the trade reporting symbols, etc. So it can get pretty complex. But from the perspective of an investor, it's obviously beneficial not to do this work individually, but to be able to look in one place and say, well, now I understand how much traded in this hypothetical State Street ETF on any given day, and you see this in aggregate. So in the US, that all is sort of, I guess, taken care of by the fact that all the trades need to be trade reported in real time effectively. And in Europe, we are heading in that direction in terms of creating consolidated tape. There are going to be most likely consolidated tapes for bonds and equities, and ETFs will form probably a part of one of those tapes, probably equities tapes. There was a discussion about creating a separate tape about ETFs, but in reality, I think that's just a great tailwind that's going to happen for the European ETF market. Because at the moment, as you can imagine, often we face situations where fund selectors, institutional investors, or even larger retail investors look at an ETF and reject it very quickly on the basis of insufficient liquidity, because they only look at what has traded in one particular listing on one particular exchange and discount all the activity happening in other listings, trade reported activity that happens on off-exchange venues, etc., etc. Just to give you a feel for numbers, based on our analysis for last year, something like 80% of ETFs listed in Europe in terms of listings traded less than 1 million euros per day. And these are ETFs that track extremely liquid indices like MSCI World, US Stocks 50, S&P 500, you name it. But you're only seeing a fraction of the total activity that can be traded, and in fact that even is traded when you look at it without consolidating. And the perspective of consolidating it manually is usually too daunting for most participants in the market.
So Gunjan, if I wanted to trade in large size and I looked at something and saw it trading $1 million, I might be concerned about what is the liquidity. How should I think about liquidity in ETFs?
Yeah, look, I think you've got to come back to the basics. And it's worth reminding, all investors that the ETF is always going to be as liquid, at least, as its underlying constituents. So if its underlying constituents, have the liquidity characteristics that you would expect, there is nothing that would lead you to think otherwise when it comes to the liquidity of an ETF. But I also think, again, often investors won't have an opportunity in some cases to really get into what is it that they need to understand before they take into consideration how to trade an ETF. And I think how an ETF trades on one day, if it's only done, 1 million shares, for example, is not necessarily telling the full story on how liquid that ETF is. I will often hear investors share, well, we don't trade on exchange big size because execution quality will likely slip. Well, Slav was sharing around 7 dealers are sometimes asked for a quote on an RFQ platform. So whilst they might be executing that trade within seconds, they've instantly, by going out to 7 dealers in the marketplace, let those dealers know which way round. If they haven't asked for bid and offer spreads, they're going to be positioned. And that could have a very material impact on the execution quality. And on exchange, we've seen ETFs of ours trade, over 100 million sometimes 60 times more than its average daily trading volume, and the execution quality has been outstanding on some of those ETFs. So I don't think it's worth looking at and putting all your decision-making on just how much an ETF might trade on a given day. I really think that's where speak to your capital markets teams at those ETF issuers, speak to the executing brokers to understand what the pre-trade might look like, what the execution experience might be on different venues, in different ways. Whether it's a big block trade, you might want to chunk that trade out, and you'll get all of that advice from your executing brokers. So it doesn't always tell the full story when you just look at that headline, and it's worth doing a double click.
So Slav, are you able to share some insights as to what types of ETFs have been trading actively recently?
I'm sure I'm not going to be able to share insights as insightful as your insights, but I think we do see mostly volumes that correspond with investor preferences. Clearly, the story of this year, I guess, one of the stories of this year, and a very major story for us, was trading the newly listed Bitcoin ETFs in the US. That's pretty interesting because Europe had multiple listings of various cryptocurrency products for quite a while before, but we never see that amount of trafficking in those products comparable to what we saw in the US. That is something which I think we expect to continue happening in the US market, and probably something that, based on our conversations, drives more interest in other regions as well. At least from the perspective, not everyone will probably be converted to investing into cryptocurrencies, but I don't think anyone will be able to afford the luxury of not having an answer about what do they think about investing in cryptocurrency. So that is probably something that we expect to continue. Something which continues to drive occasional flows is thematic products. They were discussed earlier during the day. But we have, as an example, we have a pretty active business providing to what is called a retail service provider network in the UK, and that's essentially where retail intermediaries, brokers, wealth platforms source their liquidity in ETFs. And on most days, products that are most traded on that venue tend to be fairly expected tickers, like, I know, FTSE 100 ETFs, S&P 500 ETFs, gold ETFs. But you would be surprised on how many days over last year 3 times natural liquid gas was the most traded product on that venue, right? And that doesn't seem like a first intuitive pick. I mean, that just shows how themes can also express themselves in ETFs. And I guess access to different markets and democratization of the access is one of the very important assets of what ETFs bring to the investment table.
That's great. And you mentioned retail, so maybe, Gunjan, coming back to you, retail is growing. I think many of us thought that there might be kind of a banning on inducements more European-wide, which doesn't sound like it's going to come into effect anytime soon. But are there things that can be done to encourage and help retail understand ETFs and use them?
Yeah, look, Debbie, great question. And Magdalena touched upon some of what the German market, for example, has done through their savings plan, where there are now tax efficiencies for retail investors to invest in this space. And guess what happens when you offer those financial incentives or benefits? Retail investors get smart. They take more ownership of managing their own money. And as a result, we've started to see greater and greater take-up out of that marketplace from the retail investor community. When they went to zero commissions in the US, guess what we saw? Retail investor participation took another leg higher because the financial benefit was there. And investors want to make sure that they're taking advantage of those types of structural differences when they occur through the regulations. So I think from a retail participation perspective, I really hope that different countries around Europe are taking a look at how they can look to energize retail participation in the capital markets a little bit more. ETFs offers such a unique opportunity where Slav's touched upon the democratization of investing. It really is more obvious in the ETF wrapper than I think people give it credit for. As a retail investor, whether you're trading one share in an ETF or an institutional investor trading millions of shares, you're coming in and out at the same price point, the same expense ratio. That's unique for your value proposition. That portfolio is being managed in exactly the same way for the same underlying investor experience, agnostic to whether it's a retail investor holding that or a large institutional investor that is holding that. That, again, from an investor experience benefiting from that investment strategy being managed is, I think, an absolutely tremendous example of democratization. So I think there are structural developments that can take place to really look to incentivize greater retail participation. And I do think it's important that we look to explore how retail can participate more in the European market. Today in Europe, for every $1 traded in the primary market, it's $3 in the that are traded in the secondary market. When you compare that to the US, for every $1 traded in the primary market in the US, it's $9 that are traded in the secondary market. With that secondary market depth, the execution quality and the efficiencies offered to the end investor are significantly greater. And I would love to see retail investors in Europe being able to benefit from some of that as well.
That's a great answer. And Magda, you've been working a bit with some startups in the UK. How are they, is social media an important channel to get to retail, or what are some of the ways people are marketing?
Sure. So I think, when it comes to a small issuer, definitely marketing can be a very important channel. Yes, I think, the more adoption you can get via education, the better, especially in some of the newer markets. To give you examples of some of the more recent markets that have continued adoption of ETFs, the US has had a 30-year track record of using ETFs in the passive and active space. So it's a very strong market. But looking at newer regions, you can look at Asia. And increasingly, it's very interesting to look at LATAM as well. That's a very small market. And they have a strong appetite for UCITS, ETFs. So I think social media, yes, but it starts with education. If the content on social media does include education on what an ETF is, on the exposures, then I think you're home. So yes, it can definitely help to drive some of the records, some of the flows and adoption in the region.
So Slav, Magda just mentioned the US. Maybe we can talk a little bit about this move to T+1. What is it? Why is it happening? And should we care about it?
Consolidated tape, T+1. I'm getting all the best topics, clearly.
I'm glad it's not me.
So, I mean, if you're cynical about it, you could say that the change in regulation in the US is fixing a problem of a particular company called Robinhood that happened at a particular time post-pandemic. But effectively, like it or not, the market in the US is moving to T+1 settlement at the end of May. And that's a fairly big change in terms of how people will need to operate. I would say it's not completely new to what we had to deal with in the past, right? Like, we trade ETFs with global exposures in the basket, and if you take MSCI or Country World, you have already markets that settle different to the T+2, which is the current settlement time, well, current in the US and current in Europe. So the thing that makes it a big event is obviously that the US capital market is such a huge portion of the global capital markets. Anecdotally, we have a T+1 steering committee and I'm unfortunate enough to be part of that. And one of my colleagues said recently in that meeting that we think it's a bit of a Y2K problem. Not really, like, it's a lot of preparation, but probably everything will be fine. But except me and that colleague, all the other members of our committee are probably like 3 years after graduation, which is an average age at our company. So that joke didn't really go anywhere with them. They were born all after this year, probably. So I do think it's a lot of work. It's a lot of work for issuers, and Gunjan, I'm sure, can also talk a lot about all the preparations that they're doing to handle processes both in the primary market and working with market makers and APs to make sure that the impact on the secondary market is not going to be visible to the end investors. But in reality, we think that it's not going to, I don't know, derail the growth of ETFs in Europe, for example.
Yeah, maybe I'll just add. So look, fundamentally, I think on the 27th, 28th of May is when T+1 goes live, and it's going to affect the US market, as Slav's touched upon, also the Canadian market, and also I think Mexico as well. So Argentina as well. There you go. So I mean, ultimately, you're going to have a situation where if you have an ETF with MSCI World and it's a UCITS ETF, the UCITS ETF will be settling T+2. But there will be 75% of that basket, which is going to be T+1 on an underlying basis. And that's where, again, I think it's important investors are aware of it, but it's also worth investors reminding themselves it is not a unique experience that only they will have to experience. All investors in the market will have that same experience, but it's worth making sure that you engage appropriately to understand what that dislocation in settlement might mean and how it might impact ultimately the execution experience you will receive and the impact perhaps on the price when you are trading in and out of those ETFs. It's not something that only you will be alone in having to experience, but it's again a unfortunate example of market structure in different markets where you have different regulatory regimes. We now have to price that risk taking in. So firms like Slav's, will be pricing in that some unknowns in the settlement risk that they're taking.
And do we expect the UK and Europe to do this at some point?
You know the answer to that. Look, I hope so. I hope so, because I'm a big believer in ultimately regulation should be there to support investors, and anything that fragments or puts one investor type in one market at a disadvantage to other investors in other markets, I think is just something that needs solving. So I do hope that the EU more broadly and the UK ultimately really do look to converge, so that investors can take a look at these things, can trade ETFs globally without having to factor in yet another structural nuance that is something for them to have to keep in mind. I'm all for simplification if we can get there.
Yeah, I think convergence is the key word here. I think, the US market is moving, and that's a fact. But I think we are very much now keeping an eye on what happens between UK, Europe, and Switzerland, probably. And it would be by far easier for everyone, and it would be by far easier for ETFs if the move to align with the US and change to T+1 would happen simultaneously across those markets. I think if there's going to be some regulatory arbitrage happening between, say, London and the EU, that will add further complications. At the moment, I think something just to reiterate and spell it out loud. If you're trading ETFs in the secondary market, yes, there might be impact in terms of like wider spreads in some cases. Although we think those wider spreads are probably going to be like wider by a very limited fraction. But your trades will still settle on T+2 basis, even if you're trading, an S&P 500 ETF domiciled in Europe. So that is not changing. But if you think about like what would happen if Europe moved to T+1 before the UK or vice versa, then you have a pretty bizarre situation where you have the same fund with listings in two different places, And those listings are fungible, so you can theoretically change your holdings between one listing to another listing, but those two listings live in a different settlement cycles. So that's less convenient.
Yeah, I would agree. So we have one more session after this, so I'm going to wrap this one up by asking each of you to talk about what developments or trends do you expect in the European ETF industry in the next 3 to 5 years that you're looking forward to or hoping for? I'll start with you, Magda.
Yes, so I think the retail adoption is one of the big elements here. Same for the digital channels that we've mentioned previously on the panel. But you know, because it's a capital markets and trading focused conversation, I think certainly there will be more developments in the choice. I think this will remain key. You know, at the moment in Europe, we only have the request for quote, which is the golden source. A lot of banks are developing new tools to expand the execution toolkit. So I think this will continue. And, you know, given that we have such a fragmented market, we will be looking at more choice to these tools, see the adoption there, more spectrum beyond just the RFQ protocol, and seeing hopefully more flows coming that way. So yes, I think the developments will keep coming in.
Do you want to go next, Slav?
I definitely agree on the retail point. I think we are seeing pretty exciting signs of more retail adoption in Europe, and I think that's just going to be another area of interest for ETFs. I think connected to that, and I'm bullish on the product overall and the perspective of its growth. And I think something which is pretty exciting is like we see continuous, really qualitative overhaul of how the processes work overall in the ETF world. And that just means cost efficiencies, better access to liquidity. Now, issuers like State Street, iShares, DWS, pretty much everybody represented here today, they are doing a lot of work in making sure that we can process all the transactions and we can facilitate that growth in a way that supports the demand that is coming through. And I'm very excited for how this, with maybe use of new technologies, maybe use of AI or something like that, will continue to drive the costs down and continue to increase efficiencies. Now, if you just think about it, right now we are probably placing something like 150 to 200 prime market orders per day with different issuers. And if this is going to increase to 500 or 1,000, that just needs more industrial tools. There's frictional costs in all of the manual work that happens behind the scenes. If that frictional cost can be eliminated or driven down, then just spreads go down, the cost of accessing the product goes down, and the product becomes even more competitive. And I'm very excited for that.
I'll add 3 things. You know, on top of what's already been said, I hope we do see a consolidated tape in this region within the next 3 to 5 years. I think that will do wonders for greater transparency for ultimately and investors to be able to appreciate. I think the second is I know there's work underway with the European Commission, who is examining the European landscape and exploring if there's a way to perhaps converge or bring together some of the local exchanges that we have regionally to help with the fragmentation of liquidity. So I think that's perhaps the second area that's worth looking at. The third is I hope we see more innovation in the European landscape. I am often in envy with what they can launch in the US market and what we struggle to have classified under UCITS regulations. And I hope that there's an opportunity to be more creative so that investors get to benefit from greater choice of exposures, greater innovation coming from some of the really good ideas that I hear from colleagues in the region, so that European investors are not at a disadvantage, but they have all the choice and all the benefits of all the good thinking in this region, as well as what US investors have in the US region.
I guess if anyone would like to comment, the European Commission is taking comments now for eligible assets for UCITS ETFs, or UCITS, I should say, in general. So I thought that was a great panel here discussing trading. I guess if people are interested in the role that Gunjan and her team, Capital Markets at Initiator, play, they're a great resource if you're interested in understanding the ETFs or wanting to trade. Jane Street is a great resource if you want to think about trading any ETF, because they're not kind of aligned to any single one. And Magda currently is working as a consultant. So I think there's a interesting set of experiences up here on the floor. So I appreciate you guys joining as part of the Women ETF session. Thank you for
Thanks, Deb.
Thank you. Dziękujemy.